Okay, so today we're going to talk about capital allowances. Capital allowances cover the amount of asset purchase that can go towards your corporation tax expenses. So on your accounts, when you buy an asset, this is depreciated or amortized over so many years in your accounts, and the expense gets released to your account slowly. Well, on your corporation tax return, capital allowances means that a different amount of this asset's expense will go towards your corporation tax profit and decide the amount of tax you pay. The first types of asset you can purchase are plant and machinery, and these are covered by the Annual Investment Allowance and the Writing Down Allowance. Now, the Annual Investment Allowance lets you put the full amount of the asset cost towards your corporation tax profit. So it reduces the amount of tax you have to pay by lots. So if you bought an asset for, say, 30,000 and you depreciated it over 3 years, in your accounts you would see £10,000 released as an expense each year. But on your corporation tax return, if it's covered by the annual investment allowance, the full 30,000 will go as an expense in your first year. So it will reduce the amount of corporation tax you pay straight away. Now, there is a cap on the annual investment allowance. At the moment, it's £1 million, but this is being reduced on the 1st of January 2021 down to £200,000. So there is a big onus to buy your assets before this cap is reduced. So get them in, if you can bring them forward, bring them into your year end 2021 so that you can get the full benefit of this £1 million AIA, annual investment allowance. So if you have, there are some funnies with these caps. When it moves, if you have a straddled year, it can morph your cap. So if you have a year end of March 2022, this means that you've got 9 months in 2021 and 3 months in 2022, and the cap gets apportioned accordingly. So you would have 9 months at £1 million, which gives you £800,000 AIA, and then 3 months at £200,000, which gives you 50,000. So you get 850 in total. So as you can see, the further into 2022 we go, the more your annual investment allowance will reduce. So there really is an onus on bringing this forward. Sorts of things covered by the annual investment allowance are things like machinery, computers, and basically anything you use in the direct production of whatever generates your income. So think about what you use, what assets you use on a day-to-day basis in your work, and they will be covered by plant and machinery. One thing that gets confusing is cars and vans. So vans are plant and machinery. So they are covered by your annual investment allowance and then your writing down allowance. But cars are not. The issue we have now is that recently there was a case between HMRC and Coca Cola, where HMRC looked at Coca Cola's vans. And as a result of this case, lots of things that we would consider vans in the real world are now actually classed by HMRC as cars. So in the HMRC case, they had lots of Vauxhall Vivaros that they gave to their staff, and they said they were vans, so they claimed annual investment allowance. But in HMRC actually said, well, they can be equally used to carry passengers, so they are a car. And then as a result of HMRC winning this case, Vauxhall Vivaros are now classed as cars from a HMRC perspective. On top of this, they've grouped a whole load of other vans together. So any combi vans or any vans with rear windows or rear passenger seats that have seatbelts, these are also classed as cars. So if it's classed as a car, remember, you can't use it towards your annual investment allowance. The other funny with cars and vans revolves around the trucks, like the Ford Ranger. There are specific conditions for these to be classed as a van. So first of all, they have to have a payload of at least 1 ton, and this is after any modifications you've made. So if you put like a cover on the back that reduces the payload, that would change it from being a van to a car. And then the trucks also can't have rear passenger seats with seat belts or rear passenger windows. And remember, we want them to be a van, so we can claim this annual investment allowance, get the 100% write down, and put it towards our corporation tax straight away. If the asset is not a van and it is deemed a car, then it will go into a special rate or single asset pool, where it has a writing down allowance of 6% to 18% per year, depending on the CO2 emissions of the car. This writing down allowance is based on it's done on a reduced imbalance basis rather than straight lines. So when I say it had a writing down percent allowance of 10%, and you bought the car for £10,000, that doesn't mean it gets released over 10 years, and you get £1,000 per year going towards your corporation tax. What it means is, in the first year, you will get £1,000 at 10%, but that will give you a carry forward balance of £9,000, which means in the next year you'll get 10% of that, which is £900, reduce it down to 8,100, and then in the next year you get 810, and so on and so forth. This means that a writing down allowance of 6%, it actually takes about 70 years to get the entire cost of the car as an expense on your corporation tax return. So if you do buy a car, make sure the CO2 is as low as possible and it's pushed towards that 18% bracket rather than the 6% bracket. Another thing which has changed recently is to do with low emission cars. So the government, to encourage you to buy environmentally friendly cars, is now allowing any cars with CO2 emissions of 50 grams per kilometre or less to get 100% writing down allowance. So you're effectively getting AIAs on the low emission cars. So these would be anything that's 100% electric, or anything with a very, very, very low CO2 output. And you will see that if you look at new cars, so these have to be new cars, they can't be used cars. But if you look at new cars, you will see that lots of them are marketing this fact as well. So it won't be hard to find cars that entitle you to the 100% writing down allowance. The further benefit of the 100% electric cars that have a range of more than 130 miles is that they also have reduced benefit in kind. So when a company pays for a car, on your personal tax return, what will happen is you will get a benefit in kind charge. So HMRC will say, well, you didn't receive cash, but you received a car instead, and they will put a monetary value on this car, on the use of this car, and add it to your tax return as if you earn it as money. And this benefit in kind is also based on CO2 emissions and is a percentage of the car's value. So what they've done is, with the 100% electric cars that have a long range, a medium to long range, they have reduced the benefit in kind charge to 0% in the current year, and this is then going to 1% and 2% in the next 2 years, which is very, very low. Beyond that, the benefit in kind charge ranges from about 10 to about 16%. So we're talking a very, very low benefit in kind charge, which means that if you buy an electric car, you will get very little benefit in kind charge, whereas if you buy a car with high CO2 emissions, you will end up paying a lot of personal tax if you buy it through your company. So that's covered plant and machinery and cars. There are a couple of other There are a couple of other capital allowances we can get. So there's the structures and buildings allowance. If you operate a property business, there are certain parts of your structures and buildings you can claim capital allowances on, and that's done at a rate of 3%. And then if you have any assets which are mixed personal and business use, to be honest, I don't see many of these. But these will go into a special rate or single asset pool, which also has a range of 6 to 18%, depending on the type of asset it is. But broadly speaking, the important things to take away from here are remember the annual investment allowance being reduced. So we're trying to bring forward our plant and machinery purchases. We are then looking, if we're buying a new van, to make sure it's actually classed as a van, because if it's classed as a car, we don't get our annual investment allowance. And then if you are buying a car through your company, remember the electric car rules will give you reduced benefit in kind tax.